Welcome back to Investing Talk podcast. Today, we are undertaking quite an intense analysis of a company really sitting right at that intersection of energy security and, well, the global critical mineral supply chain. We are exploring the question, is energy fuels a good time to buy now?
And our mission here is to give you the full picture because the sources, well, they present a really fascinating, complex case.
Right.
We're looking at a leading critical minerals producer, definitely high risk, but also, potentially high reward. It's driven by some truly unique assets, irreplaceable really, and an exceptional balance sheet. All this despite the fact that operationally, they're currently losing money.
It's a strange mix.
It is. It's an unusual hybrid that definitely demands a closer look.
Absolutely. And before we dive into that paradox, please take just a moment to subscribe, like, and comment on this analysis. We really do love hearing from you.
Yeah, absolutely.
And hey, if there is a company you want us to look into, make sure you leave a comment below. We do read those. Okay, let's start where I think the real value story is, the strategic moat. What immediately screams competitive advantage here is, well, the company's sort of dual identity.
Yeah.
Energy Fuels is positioned as the leading domestic U.S. producer of both uranium and rare earth elements, REEs.
That's huge.
It puts them squarely in the crosshairs of, every major U.S. initiative focused on decarbonization and supply chain security.
And it's more than just a story, though. The moat is physical, it's durable, and it's centered entirely on the White Mesa Mill in Utah.
Right.
This mill isn't just like another asset. It is effectively infrastructure the U.S. government needs. It's got unique, vertically integrated processing capabilities, and this is key environmental permits that are simply unmatched in the U.S. industry.
So hard to copy.
Think about it this way. You could try to build a competitor, but the regulatory hurdles, the construction timelines, replicating that facility anytime soon, virtually impossible. That gives them really powerful control.
And that irreplaceable infrastructure, it also allows for diversification in revenue, doesn't it?
Exactly.
You're processing uranium, vanadium, and that monazite feed material for the high-value rare earths.
Right. So if one commodity market dips, the others offer some, some resilience.
Which is important in these volatile markets.
Definitely. And when you zoom out, look at the macro picture, their function as a domestic supplier is paramount. The U.S. focus on supply chain nationalism, basically, making sure we don't rely on potentially unfriendly nations for essential stuff.
Yeah, that's a big theme now.
It is.
Yeah.
And it places this company in a premier strategic position. They are set up perfectly to benefit from that accelerating secular demand for REEs, which are vital for everything. EVs, wind turbines.
And the whole green transition.
Yeah.
And they are executing on that strategy, too. We saw some real progress recently. Final regulatory approval for the Donald Rare Earth project, for one.
That was significant.
Operationally, they hit a big uranium production number. 180,000 pounds in Q2, and they sold it at a very respectable price, $77 per pound.
Not bad at all.
Plus, they've started producing heavy rare earth element oxides, just at pilot scale for now, but still at the White Mesa Mill. These are real steps towards scaling that potentially high-margin rare earth business.
Yeah, the operational progress is definitely visible, but now we have to confront that central contradiction. The financial paradox, as we're calling it.
Okay, yeah. This is the hard reality that probably scares off a lot of traditional investors. Looking at the financials, revenue is currently modest. What is it, $65.08 million TTM?
Right, TTM trailing 12 months, so just the last year's snapshot. And you're right, that revenue figure, it's pretty small for a company trading where this one is.
And worse, the company is, well, deeply unprofitable right now. Q2 2025 saw a significant net income loss. $21.84 million. Operating loss of $25.31 million.
Yeah, the numbers aren't pretty on the surface.
The net margin is staggering, deeply negative, minus 143.05%. I mean, on paper, this looks like a cash-burning machine.
It does. It absolutely does. But you have to pivot immediately to the balance sheet to understand why this might be a strategic loss, not, a fundamental failure.
Okay.
What's fascinating here is the exceptional balance sheet. This company is largely debt-free.
Almost zero debt, right?
Their total debt-to-equity ratio is practically 0.02. That is remarkably low compared to their peers. I mean, miners are often leveraged to the hilt building out these massive capital-intensive projects.
That debt-free status, It gives them incredible flexibility, doesn't it?
Yeah.
They don't have huge quarterly interest payments hanging over them while they're trying to build this out.
Precisely. Total optionality. And their liquidity ratios, they're astounding. We're talking a quick ratio of 5.8 and a current ratio of 8.1.
Can you break those down quickly?
Sure. So the quick ratio basically tells you how much cash and easily sold assets they have for every dollar of short-term debt. A 5.8 means they have nearly $6 ready for every $1 they owe immediately. Wow.
Yeah, that is a fortress balance sheet. It's designed to withstand big market shocks and fund that long-term growth without being totally dependent on today's commodity prices.
And that position only got stronger recently. They announced that huge $550 million convertible notes raise. Now, you hear convertible notes, you might worry about the dilution, and yeah, that can put some temporary pressure on the stock price.
It can, sure.
But the market seemed to view this correctly, I think, as a massive bolstering of their financial firepower, like a war chest.
Yes. And the strategic implication is critical. You have to ask, why raise $500 million when you already have such strong liquidity?
Right. What's the plan?
Because they're positioning themselves for something big. Large-scale expansion, maybe government-backed projects, maybe strategic M&A, those operational losses we see now. Arguably, that's the cost of acquiring future dominance in domestic critical minerals. It's a price they can afford to pay because of that fortress balance sheet. Okay, that reframes the losses entirely. It's like an investment in becoming essential national infrastructure, not just a struggling business.
Exactly.
So let's shift gears. How has the market reacted to this duality? Let's look at the technical picture.
Well, the stock's had a phenomenal run, no question. It moved from a 52-week low of, what, $3.20?
Yeah, way down there.
To a recent trading range bouncing between, say, $14.84 and $16.39. That kind of huge move, that volatility, it suggests serious institutional interest and massive momentum.
And the charts seem to back up that bullish view. The price is currently trading well above both key moving averages. The 50-day SMA, the simple moving average, is at $11.48. And the 200-day SMA is way, way down at $6.67.
And for listeners, the SMA is just the average price over a period, when that shorter-term average, the 50-day, is significantly above the long-term 200-day. That's a classic textbook bullish signal. Shows strong underlying momentum.
Okay.
And furthermore, the RSI, the Relative Strength Index, it's at 60.09. RSI measures momentum, often used to see if a stock is overbought, kind of run too far too fast. At 60, it suggests the stock is bullish, yes, but not yet exhausted. It still seems to have significant room to run higher.
So the technical picture looks pretty strong. The immediate hurdle, the resistance level, is that 52-week high at $18.78.
Correct.
But some technical models are forecasting a really ambitious trading channel, potentially reaching up to $24.74 through mid-November 2025. That sounds like massive conviction from the chart watchers.
It really does, which is why this analyst disconnect is so, well, jarring.
What's the disconnect?
Technical models pointing towards, say, $24 maybe, but the consensus analyst ratings, okay, it's one strong buy, two buys, so positive leaning, but they land on a consensus price target of only $10.38.
Wait, $10.38? That's way below where it's trading now.
Yeah.
The street thinks the stock should be trading like 40% lower, while the charts predict another 50% upside.
Exactly. It's not just a disconnect, it's a chasm.
What does that mean?
It suggests analysts are either really slow to bake in that strategic geopolitical premium we talked about, or they are severely underestimating the impact of catalysts that might be just around the corner.
Or maybe just waiting for proof in the numbers.
Precisely. They might be waiting for the next earnings report to justify catching up, which actually brings us perfectly to the near-term volatility triggers, the stuff we need to watch over the next, say, 1 to 3 months.
Okay, number one trigger has to be that Q3 FY Q4 2025 earnings report. That's due October 30th, 2025.
Yep. Mark your calendars. Any positive surprise there, maybe better revenue, maybe more clarity on the rare earth timeline, that could be explosive for the stock.
Trigger number two, how they plan to use that huge cash infusion, the $550 million.
Capital deployment clarity. Exactly. Is it going towards immediate growth, CapEx, spending on infrastructure, physical assets, or is it being earmarked for M&A deals that add value? Just announcing a major spending plan could immediately help justify the current valuation.
Makes sense. And the third trigger, It's got to be the speculation around U.S. government contracts.
Always bubbling under the surface with this one.
Given the White Mesa Mill's unique position, there's constant talk about potential U.S. government supply deals or rare earth processing grants. We did see some minor insiders selling recently, like 4%, 5% reduction by a VP and a director. Looks like maybe routine profit-taking.
Probably. Nothing huge, suggesting lost confidence.
But a federal contract announcement, that would absolutely dwarf any minor selling activity.
Well, completely. And beyond the next 3 months, the focus shifts to those longer-term tailwinds. We're looking for progress in actually scaling up the full rare earth separation process, not just pilot scale, maybe further strategic alliances, and just that continued political momentum driving supply chain localization and North American decarbonization.
So it's a multi-year bet.
Fundamentally, yes. It's a bet on the U.S. deciding it needs to control its own critical resource destiny.
Okay, we've built a very strong bullish case here, it feels like. But, no stock trading on future potential comes without risks. We absolutely have to acknowledge those.
Absolutely. 3 major risks really stand out to me. First, financial execution.
Back to the losses.
Yep. Those ongoing losses, the negative cash flow, that is a risk. They need either a significant, sustained turnaround in uranium or rare earth prices, or just excellent cost control to reach profitability. It's not a cash cow yet, not even close.
Fair point. Second risk.
Dilution risk. While that convertible note raise was strategic, like we said, it could still weigh on near-term per-share metrics, especially if the stock doesn't appreciate quickly enough to absorb those potential new shares when the notes convert down the line.
Okay. And the third?
It's a commodity stock, plain and simple. Revenue, profitability, they are highly sensitive to fluctuating spot prices for uranium and rare earths. The whole thesis right now relies heavily on those prices continuing their upward trend, driven by that macro necessity. If that reverses...
So does the stock. All right, so what does this all mean for you, the listener? If we try and synthesize this entire stack of information, our overall rating comes in quite bullish. We're landing at an 8.5 out of 10.
That feels right. The rationale really rests on that kind of triple threat. The fortress, debt-free balance sheet, the defensible moat as really the only significant U.S. critical minerals producer with these assets, and that favorable technical picture well above key support levels.
So how should someone approach this?
Well, the investment horizon seems flexible here. You could approach this as a shorter-term trade, maybe trying to capitalize on the volatility around those upcoming Q3 earnings or capital deployment news in the next 1 to 3 months.
Sure.
Or you hold this for the long term, the multi-year story, betting that the structural demand for these minerals and the whole supply chain localization trend will eventually make the White Mesa Mill, and therefore energy fuels, a critical, indispensable national resource.
It really does feel like a structural story, more than just quarterly earnings. Which leads me to this final, maybe provocative thought for you to consider. We saw the company is currently losing money on paper.
Yeah.
But they have the capital, potentially $500 million plus, to keep going. Consider the implication. If this company's valuation is being driven almost entirely by future strategic necessity, U.S. supply chain security, rather than its current, GAAP profitability. What happens to that share price on the day those speculated potentially massive government contracts actually get signed? That optionality, that potential step change in value, that's really what you're buying today, isn't it?
That's a powerful way to frame it. A reminder that sometimes strategic value can far outweigh present-day accounting numbers.
Indeed. Well, thank you for joining us for this analysis. Stay informed, keep questioning your assumptions, and we'll catch you next time.